everyone. Welcome to this webinar on VAT and customs duties increases in Saudi Arabia. This is the second of a series of 3 webinars that we at Bracewell are hosting in partnership with our friends at BDO. Welcome back if you attended the first one. We're very pleased that you could all join us. I hope you find it useful, interesting, entertaining, and perhaps all of those things. I'll hand over in a minute to Brian Conn and Mohammed Madbouli at BDO, who will introduce themselves, and they'll take you through the detail of the VAT and customs increases. Then we'll have Andre Cormut, who is a project partner here at Bracewell. He'll give you the lawyer's view of the world. Andre is, I know from personal experience, doing a lot of Saudi work at the minute, advising clients on a daily basis on these very issues. So hopefully enjoy getting the benefits of that expertise. I'm a partner at Bracewell. I specialise in construction, so I'll give you a little bit of commentary on issues you should be thinking in terms of EPC and construction contracts. I've got to say, I don't often get excited about tax, but the increases in Saudi Arabia, I think it's fair to say, it was a tripling of VAT from 5% to 15%. And honestly, it made headlines around the world and not just on the finance pages. Saudi and the other GCC countries are viewed as no tax or low tax environments, and prevailing VAT rate of 5% didn't really alter that, but I think 15% certainly does. And the speed at which it's being introduced is really breathtaking, and certainly businesses are having to mobilize the resources pretty quickly to work out the impact of the change. Customs duties probably didn't generate the same degree of press coverage, but certainly in the energy and infrastructure space, which is where we as Bracewell are most active, it's very significant. The participants in those sectors utilize international supply chains, and the breadth of these increases means they're going to be of great interest to parties doing international projects in Saudi. So that's almost it for me for the time being. Just before we get into the webinar, a couple of housekeeping matters. You'll see somewhere on your screen, I think there is a place where you can type in questions, and the team at BDO will review those as they come in and direct them to the right presenter. We'll also have a Q&A at the end, so feel free to ask questions then as well. My understanding is at that point you can raise your virtual hand and the BDO team can bring you in on audio as well, if that is your preference. So let me hand over to Brian and Mohammed.
Thank you, Tom. And I'd like to say, first of all, it's a great pleasure once again to share a platform with Bracewell. My name is Brian Conn. I'm a regional tax partner for BDO. And I'd like to introduce you to my colleague, Mohammed Madbouli, who is Senior Manager in our Riyadh office. Also behind the scenes, you can't see them, but Nishi and Shirley, also from BDO, who are the moderators today. So you'll hear from them later when we get round to the questions session. Right, let's push ahead. Quick look at the agenda for today. We'll look at this VAT rate change that Tom said came as a surprise to all of us when it was announced. We'll have a little look at an overview of what's happening and the transitional rules. There's some very important transitional rules that will make a big difference to contracts that are already in place. We'll look at the customs duty. In some ways, the customs duty will make a bigger impact on some businesses actually than the VAT, despite the fact it hasn't quite had the publicity, as Tom says, as the VAT rate did. And then finally, Tom and Andre will look at the impact on projects, infrastructure, PPP, that are in progress or in the pipeline in the kingdom at the moment. So we'll look at this rate change first of all. It was announced on the 1st of July, 5% to 15%, a tripling of the rate, and absolutely no exceptions. So everything that was 5% before becomes 15%. Now, the announcement was made on the 11th of May, and the 11th of May is a very important day because it starts the transitional period for the changeover. So there are special rules for contracts and also invoices that are dated prior to the 11th of May. The logic being that if you entered into those things or issued an invoice before 11th of May, you didn't know the rate change was coming, so there is some relief for a temporary period. There's an amendment to the regulations now. I think they're only still available in Arabic. There have been no changes to the General Agreement on VAT, the GCC agreement on VAT. And I think it's just worth saying that although those regulations are only in Arabic at the moment, it is well worth concentrating on those regulations. I think some of the wording in the regulations is a little different to the guidance that has been issued. Mohammed, you've looked at the new regulations in detail, and I think there are a few little differences, both from the Arabic guidance that came out and also the English guidance that came out in the first place.
Yes, there is a little bit difference between the guidance which previously published related to the transitional period. The transitional period have a lot of conditions, like the receiver of the service, continuous services, must have or must be able to claim all the input. The guidance issued that the receiver of the service must be able to claim all the input VAT, but the regulation changes said that the receiver must be able to claim all VAT in the specific services received. So the receiver or the buyer of the service must be able to claim all VAT related to this service, not as a public for all its inputs. So this is a little bit difference, but very critical difference between the guideline and the Arabic guideline and that transitional changes regulation.
Yeah, thank you. And the point is, of course, that the regulations, the Arabic regulations, will take priority. So those are the ones that you should rely on. We can have the next slide, please. We'll have a look at these special rules. So there's two sets of rules. Firstly, for contracts signed before the 11th of May, contracts with governmental bodies and also contracts with VAT registered businesses that can reclaim VAT in full on the contract services. And this is the point that Mohammed was making, that in the regulations it makes it clear that it's businesses that can claim back VAT in respect of that contract. So not generally, it's about that contract alone. There's also a set of special rules for invoices issued before 11th of May 2020. And in both cases, so for both of these special rules, the effect is that the 5% rate can continue to apply to any goods or services supplied as a result of those things until 30th of June 2021. So we'll have a look at some examples in a minute, but just to dive into these transitional rules a little more, we have a look at the next slide. The contracts signed before 11th of May with government bodies and VAT registered businesses. Important point here, the 5% applies until, as I say, maximum 30th of June 2021, or expiry of contract or renewal of contract. And you know, one question that arises out of that is what is seen as expiry of a contract. And it strikes me, if you make some major changes to the contract, that could actually be seen in the eyes of the tax department as creating a new contract and therefore bringing to an end that transitional period. I don't know, Tom, whether you got any thoughts on that from the contractual point of view?
Yeah, so Andre and I were talking about it this morning, and our view is that if you think of the reference to the earlier of, this is clearly supposed to be a time-based test, and so if you are amending a contract in a way which doesn't impact anything to do with time of delivery, time of performance, then I think that type of amendment would not be captured by this mechanism. Andre, you have some thoughts, right?
Yeah, absolutely. I think we make that distinction between the time and the substance of the contract, and certainly when we go to amendments that go towards the substance, that perhaps it's probably quite arguable, given the fact that this is obviously untested territory in the first place, that we wouldn't get into the expiry or the renewal zone. That being said, I think we do need to gauge everything on the basis of their facts, and this is a sort of a typical advice we give to all our clients, but it is true. One does need to have a look at the contract. One does need to consider what, for example, in the instance of an amendment, does the consequence of that amendment have on that contract, and whether or not the intention behind that amendment is to service a particular commercial rationale, or is it primarily to service rather the avoidance of a tax liability. And I think certainly in the latter, that could be a bit of a difficult situation to deal with. But yeah, to Tom's point, I think the issue is in relation to timing.
Right, thank you. Yeah, I think it's an area to be cautious of. And one thing is for certain, is that when the Gazat, the tax authority in Saudi Arabia, carries out its tax audits, anybody who has used the transitional rules can expect Gazat to check this all out very, very carefully. And I think we've seen them, Mohammed, do this when we had the transitional rules before, when VAT was first introduced. Yes,
Gazette will look for this contracts related to in 2018 it was zero rated contracts until the end of the transitional period. So Gazette need to check the implementation of these rules, are it correct or wrong, and we have a lot of vendors we know ask our clients to change the zero rate to be 5% as they are applied it in wrong. So our clients come back to us to ask, is this correct or wrong? So it would be better to be very careful from the beginning to apply the correct rate, whatever it is, 5% or 15%, because this will be under auditing from Gazette more than the contracts will be 15%.
Yeah, thank you, Mohammed. And just building on this, we talked about the fact that the customer must be able to claim back VAT on the contract. One of the things that Gazat said when they conducted a webinar on this, that all of the responsibility for showing that the customer can claim back VAT is on the supplier. So if the supplier wants to continue charging 5%, it's his responsibility to get confirmation of that, and if necessary, prove that to Gazat. Now that's a strange way round actually, because it's providing a responsibility on the supplier to prove something about their customer. So all you can do in those circumstances is make sure you obtain written confirmation from your customer, signed off by a very responsible person, stamped by the company, whatever it takes to make that document as official as possible. But it is quite clear from the Gazette And I think that's been confirmed several times, hasn't it, Mohammed, that the responsibility is with the supplier.
Yes, as you said, Mr. Brian, the responsibility will be in the supplier, but the problem become bigger when the supplier, if the supplier wanted to collect the 15% without going to 5% to not be in risk. Unfortunately, Gazette did not allow the supplier to apply the 15% unless he get an acceptance from his client. So the supplier will be stuck between the Gazette and the client to collect the correct fees, the correct rate, whatever 5% or 15%, because it will be his risk, and to not apply the 15% unless he get approval from the client to apply the 5%. If the client refused to apply the 15% and insisted to apply 5%, the burden will be in the supplier, not in the client. But we can make a memo for while we can have a certificate from the client that he is able to claim all the input VAT related to this supply. We can put a memo that if there is a mistake or unclear information or wrong information in this certificate, he can return back to the client. But not all the vendors or supplier of services can do something like that. So it will be the risk on the service provider or the provider of the goods and services.
Excellent, thank you. If we can have the next slide. So just a little example. It should be relatively straightforward based on what we've said before. But if we've got a contract in place, in this example, signed 1st of January, so that's before 11th of May 2020. What it means is that, so say this is a building contract, all of the milestones until 30th of June 2021 will all be at 5%, and thereafter everything will be at 15%. We have the next slide. The contra, of course, if those rules do not apply, it's hard and fast from the 1st of July. Any work completed or goods delivered after that date is 15%. Work completed before or goods delivered before is at 5%. Now, there are some potential issues. There are also always some practical issues around these things. And one of the things is a question of work delivered. When is it completed? If you're in the sort of business that BDO and Bracewell are in, professional services, how do you prove that you've completed a certain amount of services up to a certain date? Or building contracts particularly. I mean, I'm assuming for a building contract, it would be a matter of when it's all signed off by both parties. But Tom, I know that's your theory. In terms of building contracts, if we want to say absolutely work is completed at a certain stage, how do we measure it?
My view actually is that building contracts are probably mostly straightforward. Well, most of the ones that we work with are done on a milestone basis, as you just mentioned. A certain milestone is complete, an engineer whizzes around with a clipboard, yep, all looks fine, and issues a certificate, and it's the date of the certificate, or which will be when the work is completed. I think it's interesting what you said about professional services, because I think about the work that I do at my desk every day, and most of the emails I send out are advice of some sorts to clients, which might not get billed for a month or 6 months, and working out how to unpick what the discrete tasks were when they were completed and delivered, and then how to invoice that could be a headache. And I'm sure that perhaps plenty of people who attend this webinar could think of examples like that relevant for their own sectors or expertise, where it might not be so clear cut as certification under a building contract.
Yeah, and there's some good points there, and I think in some businesses it is easier than others. Obviously, if you're delivering TVs, you know when you deliver it and you can prove you got a delivery note. With services, it is much more difficult. I have to say, although this is just a practical point rather than a legal technical point, but I would say it's safest if you can make sure that any invoice that is issued from 1st of July onwards has 15% on it. You know, in theory, you could say, okay, the work was completed before and we're issuing the invoice late, but I think you will run into problems with the Gazette if you do that. So in my opinion, if the invoice is dated July onwards, then it should be subject to 15%. Would you agree with that, Mohammed? Purely.
Sorry to interrupt. I was going to say, is the lesson there for everyone to get their invoices out on the 30th of June?
That is the big message, actually, and I'm sure all the accounts departments will be really happy, actually, if everybody actually just gets their invoices out. So
yeah, it could be a busy few days for that.
Yeah, absolutely. Mohammed, did you want to say anything on that?
Yes, in some services, especially in services, not goods, because goods we can deliver goods in the specific dates. But on some services, it will be difficult to prove the date of delivery of services. But like accounting services, if we are reviewing or auditing a firm, we have to deliver our audit report before that date, not just issue an invoice. Also, if we have providing some advisory services, we have to deliver the report of this advisory before the end of June 2020. So there is a lot of evidence according to each sector, but we have to have an evidence. This evidence would be different, but maybe an email, maybe a report, whatever approved from the client that he received the service or agreement with ending date. So before issuing the invoice with 5%, we have to have the evidence of delivering the service.
And that is a very good point. That's the contra to making sure you get your invoices out early. You know, you can't bill in advance sure. and claim it's 5% if you're not going to deliver the work before the 1st of July. So, you know, the invoice, they're doing the work, everything needs to match up because Gazette will be checking this undoubtedly.
Sure.
Okay, can we have the next slide? There are also transitional rules for invoices. I think the assumption is if we're looking at invoices, there is no contract. So, for example, invoices issued to individuals, you know, for an insurance on a car or something like that. I think if there's a contract with a different date, I think probably the contract would take priority. But the similar sort of point, if you've invoiced everything before 11th of May with 5%, without expecting that the VAT rate would rise, then provided the service or goods are delivered before 30th of June 2021, then you can stick with the 5% rate. We have the next slide. So just again, a very simple example of this. An invoice was issued, and this could have been for a motor insurance, 1st of January 2020, all the VAT charged up front at 5%, and the service will be completed over the year, terminating end of December 2020, but there is no adjustment to be made because the invoice was raised before the relevant date. Okay, so if we move on, customs duties. This was really quite a surprise to all of us. The VAT rise was a surprise, but this also came in very quickly. And I understand the tariff changes are now in effect. After the initial announcement, there was some suggestion that the changes would be delayed and that they wouldn't come in for a while. And there has been a few changes to the original proposal. The original proposal that came out listed, I think, over 1,000 individual items, which has been reduced. The most recent tariff list we've seen covers something like 520 or something like that. But it is a very, very wide range of articles that are covered. We'll have a look at some of the broad headings in a minute or two, but it's a very wide range of products, and we have rates up to 20%. And these are on goods that some of them previously were at 5%. 5% as a general rule applied to most things coming into the kingdom. So we've got a varying rates, 5, 10, 15, 20%. Now across a wide range of things. Mohammed, have you heard any more updates on this? Because there were some changes, weren't there, from the original announcement?
According to our information, custom duty in Saudi Arabia announcement that there is more than 1,000 items will be increased at the beginning at the early of June 2020, but literally they reduce these items to be about 500 items after reviewing the previous announcement. So they reduce the items to maybe about 50%, 50% of the items just will be tariff, will be increasing custom duty.
Yeah, okay,
and I think,
thank you.
According to our information, they applied a few days ago, not at the beginning of this June, of this month.
No, I have seen one publication from the Customs office now that Mohammed shared with me a little while ago, which sets out the products and the rates both in Arabic and English, which for me was a great help anyway. So we can have the next slide, please. Okay, a few points to make about customs increases. The point about customs duty is that it is a real cost, whereas VAT for most businesses is a cash flow item. It's paid out on your costs, but you get a refund for it and then you pass it on to somebody else. That's not the case with customs duties. Customs duty is paid when the goods come into the country, and that's the end of the story. You don't get a refund of it in normal circumstances anyway. So it creates some genuine costs, real costs that need to be funded, as well as the pure cash flow, the fact that you will have to pay out more in the first place to get the goods into the country. It does make imported goods more expensive, whereas VAT, you know, they come in, the VAT is charged and claimed, doesn't necessarily make imported goods more expensive. Customs duty does make imported goods more expensive. And it also actually increases the amount of VAT on the goods. The way VAT is calculated when goods come into the country is that VAT is the last thing that's added. So the VAT is calculated based on the duty paid price. So if the customs duty rate goes up, then there is an increase in the amount of VAT that will be payable at import. Now, generally that VAT will be recoverable, but if it was coming in for a business that could not claim back VAT for whatever reason, then again it creates another real and additional cost. So customs duties, big impact potentially.
Also, Mr. Brian, as VAT can be claimed, but the problem will be in cash flow because not all the importer can claim the VAT in the current months they paid the VAT. So maybe it will affect also the cash flow of the importer. Yeah,
absolutely, absolutely. There is a combined effect there: the customs duty and the VAT, the cash flow, the genuine funding cost. This is by no means an exhaustive list or a very detailed list at all, but it just gives a feeling for how broad the scope of these increases are. There is a huge list of foodstuffs that are affected. lots of building materials, metal products, lots of items that will be used in the energy sector, parts and appliances for machinery. So it is going to have a very broad effect. So like I say, that shouldn't be taken as any sort of definitive list, but it is just an example of the sort of things that are covered by this increase. What I want to just touch on really is best practice when dealing with customs duty. You can't avoid customs duty. If you want to bring the goods into the country, you have to pay customs duty. But a lot of businesses pay too much customs duty, and it is worth just making sure that everything is managed properly in order to make sure you pay the right amount. As an example, the product classification, the HS code that is used to bring the goods into the country. Each product uses a different HS code, and that drives the customs duty to be charged. So just looking through the lists earlier, and this is just a very bland example, natural butter will be chargeable at 6% duty, whereas dairy spreads derived from milk that are not butter will be subject to VAT, to customs duty at 15%. So a mistake around the classification of the goods can make a big difference in the amount of customs duty that is paid. You need to check whether there's any sort of reliefs available. There's not too many reliefs in Saudi Arabia, but there are some, and some organisations, for example, military equipment going to the Ministry of Defence is exempt from duty. So it's about making sure any relief is taken advantage of, and also the valuation for goods. Sometimes additional costs get into the price on the invoice. So it's possible sometimes to unbundle certain costs or non-dutiable items in order to make sure, again, you're using the correct price, the correct cost for importation. So there are some things you can do, and indeed there are some bonded facilities in Saudi Arabia, such as Jeddah Islamic ports, where goods can be held without payment of duties before release into the market. That can help with the cash flow. So there are things that you can do around it, and I think there will be more of this sort of thing now. Before, everybody just said, well, it's 5% and just accepted it. Now I think some of these things, if you're a large importer, it's worth just making sure you've got these things right.
Brian, just to maybe interject there for 1 second, and perhaps a question to you from a practical perspective. The HS codes are allocated before delivery to the kingdom, right? So to the extent that you do make a mistake in respect of the code that's applied, in respect of the material that's imported, it's not something that can be changed after the fact, can it?
Well, the HS code will probably be applied by the agent when they prepare the import entry. So at that point, the agent has the opportunity to do the classification. So it's just making sure that this is something that is normally in the hands of the agents, and it's making sure that those agents are doing the right thing. What unfortunately we see sometimes is that an agent uses the same codes every time for a particular customer,
Sure.
and it just happens. And it's not saying that they're being negligent or anything. It just happens. So it's just rechecking and making sure everybody's using the right codes at the right time.
Which in the past was not so much of an issue if the broad sort of 5% was allocated on most products imported, whereas now with the classifications and the variety, as you've mentioned and Mohammed spoke about, of customs duties that are chargeable, then this becomes all the more important.
Yeah, absolutely. It's something certainly to watch out for, and I've seen in the past many cases where wrong HS codes have been used. And you can see from that little example with the butter, it's very easy to just classify something slightly wrong. Right, I think that's probably the end of my section. So I'll hand over to Tom and Andre to take things further.
Brilliant. Right, so this is the melting pot. This is where you take all the knowledge you've just received and you apply it to the real stuff on the ground. So as Tom had mentioned, our projects partner at Bracewell, and Tom is a specialized partner in construction. We both deal with this issue because it's relevant insofar as it relates to our concession agreements for our clients, and then obviously the construction agreements that we have in place for the development of the various deals that we've got in the kingdom. Now, as it so happens, I think everyone's aware of the fact that Saudi continues to be a buoyant market and an infrastructure hungry market, and I think that's probably a trajectory that will last for some time to come, and we're obviously grateful for that as legal service providers. But that also means that, particularly I think in the context of the current economic climate with COVID-19 and perhaps some of the consolidations in the fiscal positions of most GCC countries, never mind Saudi Arabia, PPPs, which is public-private partnerships, are going to become more and more prevalent, and that obviously means greater participation and involvement of the private sector, and perhaps some extensions in terms of the way that repayments of the infrastructure costs are done. So one of the classical ways of doing this in the region, and it's been certainly proven and tested years after years on a number of deals, is through the sort of PPP model of a offtake or a concession document, which is what the second item is on the slide. And in the context of these, some of them predate VAT altogether, but certainly in the current format, we've identified that certainly all of the wastewater deals, all of the water desalination deals, and also all the power deals currently run a type of VAT gross up or inclusion in the tariff schedule, together with some sort of a customs duty exemption program. Now, this becomes all the more relevant now because, as Brian and Mohammed have mentioned, obviously from 5 to 15 to 20% in terms of customs, the numbers do make a difference. And I think it's something that we've spoken to our clients on a number of occasions and we continue to speak about, because it is going to move the needle insofar as cash flow is concerned, and obviously the underlying costs. So if we move on to the next slide. Do exemptions apply? And this is quite important, and it's an interesting topic, particularly in relation to the sectors that I already mentioned: power, water and wastewater. All of those tend to be done on PPPs, as I've mentioned, and they do tend to go via a type of an offtake or a concession agreement, which refers to what is referred to as the customs duty event. And the customs duty event usually entitles the developer to recover on the cost of the customs that are paid. But the way that the customs duty event essentially works through the documents is that you essentially need to be denied a customs duty exemption, which in the first place basically obliges you to apply for an exemption in the first place. Now, there may be certain interpretational issues around this front. I think we take a broader view in the sense that the intention behind these documents is to pass through the customs cost, and as such it makes sense, particularly in relation to infrastructure, which is ultimately consumed by the public and by the kingdom at large, that it wouldn't be paying for its own customs, only to be recovering it at the port. So that does have some element of logic, but as Brian had already alluded to, there are obviously implications in relation to the other item, which is VAT. So we've spoken at some length, I think, around tariff codes. We won't go into that. The one thing that I think does need to be mentioned is that there is a requirement under most concessions that we've seen recently in the market that you do look at the local market, certainly to the extent that you have a customs duty exemption or customs duty passed through under the concession. One of the precursors to that is that you haven't been able to obtain the material or the equipment locally. And I think that's quite an interesting topic, probably not one we should spend too much time on, but maybe from a high level would inform also some of the reasoning behind these policy changes in the kingdom. It seems to me, at least, and I think, Tom, I don't know if you have a different view, that the kingdom is driving towards localizing manufacture, localizing industry, processing beneficiation. That may be, to Brian's point about spread being more costly than butter. Maybe there's a bit more process involved to those items than the alternative, and perhaps that's what the kingdom is thinking about. It wants to locate industry and manufacturing in the kingdom a bit more and be less reliant on importation of goods from elsewhere.
I think that's right. I think I remember years ago, Vestas, the Danish wind turbine manufacturer, established a manufacturing facility in Brazil. It's quite unusual, very high tech equipment being manufactured locally, and I think it was just because Brazil in the Americas was such a huge market. And as you said, Saudi here is it's the big market in the region. It's throwing a lot of work out to surrounding GCC countries. We're all very busy on Saudi projects, and the Vestas example is a bit extreme, but you can certainly imagine a scenario where more low tech bits of kit, you can see a sort of manufacturing base building up in Saudi as people look to avoid the impact of these customs tariffs.
Great, so moving on to the next slide. So this is a very simple example in terms of what you could logically see in terms of the increase of VAT on a $500 million price tag. Again, this is just a nominal figure. It's not necessarily the exact sort of cash flow issue that you have to face. It's worth mentioning that certainly in PPP projects where the construction period is obviously extremely capital expenditure heavy with no revenue coming in, that the VAT that's essentially paid with respect to the services and the products delivered is essentially aggregated in the project company. And that aggregation of that means that you have no way of netting it off against sort of tariff or revenue that you would have otherwise charged out, and therefore charged out VAT. And for that reason, you're almost entirely dependent, if not entirely dependent, on the reimbursement mechanic that's available to you. Now, if we're talking about quarterly basis, that does mean that you have to tie over some VAT with respect to your budgeting and expenditure for that 4 or 5 month period, whatever it may be. Certainly, I think the indications we've had from the market, and I'm sure probably Brian and Mohammed will be able to speak to this too, is that it is a relatively smooth process and that the reimbursements are processed speedily in a timely fashion. So there is a degree of predictability in terms of when the reimbursements will actually be made. But be that as it may, it's still a number to be borne in mind, and it's certainly a very different number to the one that we had before, which is 5%. Now, what I think is worth also mentioning is that historically, the way that a lot of the infrastructure projects have been financed is on the basis of working capital facility, which had essentially absorbed the cash flow point of the 5% VAT. But with 15%, again, that's something that serves rethinking and something that one should think about a little bit further. If we move on to the next slide. Right, so this is where we go to the revisiting of the financial model, which is sort of touched upon a little bit more, and obviously the cash flow position, obviously considering the short-term, long-term funding requirements vis-a-vis what the outgoings are on that and other items. Perhaps at this point also worth again re-emphasizing that, as Brian had mentioned, that is the last component to be charged. As a result of that, again, if we've got the extreme example of a imported material which is at 20% customs duty, the VAT will be applied on the essentially 120% of the actual cost of the item. So that again increases the ticket there a little bit more than what we had originally anticipated. Moving on to the next slide.
Okay, I won't talk in detail to all these points, but let me give you a couple of interesting thoughts from an EPC contract perspective. If we think about payments of VAT and customs, for example, one of the things to think about is, VAT. And let's think of a PPP context. We have a sponsor or developer who's engaged a contractor under an EPC contract. The VAT liability is the sponsors or the developers. But often, as a matter of practice, it's the contractor who has to pay out in satisfaction of that liability. So, for example, at the quayside, when the goods are coming in, the contractor's at the quayside, unloading off the ship, getting them customs cleared, getting them on lorries, and all the rest of it. You know, it's at that point the Saudi tax authorities hold out the hand and say, well, pay us the VAT, and then you will get your you'll get your goods. So it might be in the sponsor's developer's interests to you know, engage the contractor as an agent to pay out that liability on the sponsor's behalf. And then from a sponsor perspective, you need to make sure that if you've paid out the VAT at that point, when the contractor provides you with its invoice at a later date, that you are not doubling up on that VAT payment. The other thing I wanted to mention was Brian talked earlier about alternative sourcing in the local market. On a lot of these PPP projects, as Andre mentioned, you have exemptions which apply for the benefit of the project. So if your EPC contractor is bringing stuff into the country, hopefully you'll find that that is exempt and the customs duties payable on those imports are nil. However, if you've got a local content requirement on your EPC contract, which requires you as EPC contractors to go to the local market, and you're buying those goods in the local market, your supplier may be manufacturing those goods based on imported materials which don't have the benefits of an exemption. So weirdly, you could find that your locally procured goods are indirectly more expensive because the imported raw materials don't have the benefits of an exemption. So yeah, next slide.
Right, is that mine?
As is yours, Brian.
Some just final thoughts, and I'll go through the last couple of slides very quickly because then we've got time for a few questions. There's a really wide impact to all of this, and you know, at the top level, additional VAT, additional customs duty may affect the demand for some items, and there are pricing decisions for businesses to make. Do they absorb some of the costs themselves? Can they pass it on to their customers? When VAT came in, we saw people trying to capture the market by saying, we pay your VAT for you, or no VAT increase. They didn't increase their prices, they just paid the VAT out of what they were receiving. There are some decisions to be made there. And this is not, the second point there is not just a Saudi point. Anybody who's selling into Saudi Arabia needs to consider whether or not suddenly the market for their goods will change because of these additional costs in Saudi Arabia. On a very practical point, ERP systems, point of sale systems will all have to be updated so that they can cope with the new rate. Particularly point of sale, you know, if businesses are open over the changeover period, they're going to have to suddenly change from 5% to 15%. So hopefully everybody's got that ready and waiting. When it comes to accounting systems, we're suggesting that everybody is able to record both 15% and 5%. You will need to do that going forward for quite a while because you may have to make adjustments and you may have to account for some invoices 5% because you're using the transitional rules, some invoices are 15%. So suddenly your VAT accounting has become a lot more complicated. And the last thing there, I think we still haven't got any changes to the VAT return, which at the moment can only cope with 5%. I think that's correct, isn't it, Mohammed?
Yes, Mr. Brian, until now we didn't receive any announcement related to the VAT return, but we have webinars or meetings with Gazette. They told us that they will allow to use the two rates, 5 and 15% in the future, starting from July to 2020. But until now, nothing formal published related to the VAT return.
Okay, they've got a couple of months to get it in place, so hopefully that will be done in time. If we can have the final slide. These are just key takeaways, just a summary of the points that we've already talked about. I think because we've only got 10 minutes to go, I think let's take a few questions at this point. Nishi, do we have anybody there waiting to ask a question?
Yes, Brian, we do have some very interesting questions. So the first one that we have is from Badi Zaman. Let me just... Hi, Badi, can you hear us?
Yeah, I can.
Hello, Badi.
Hi, how are you?
Very good, very good. What's your question?
Yeah, it's a simple question. I'm not sure it's relevant to the discussion we are having. So I wanted to know, is there any exception on VAT increase to school fees, because it will impact the businesses where employees are paid the school fees by the company. So is it still 15% increase, or are there any exception for school fees?
No exception for school fees. School fees 15% as normal. Mohammed, any comment on school fees?
School fees will be related to the individuals as they are the receiver of the services. So, and the service will be rendered after June 2020. So most of the school fees will be subject to 15%, and the transitional period related to business to business will not be applied in the individual.
Okay, thank you.
Presumably by prepaying the school fees, you would get caught by the transitional arrangements that you had mentioned before.
If you had an invoice before 11th of May, it's too late now though. So, okay, thank you for that, Buddy. Nishi, anybody else?
Yes, up next we have Fahad. So I'll just put him online. Hi, Fahad, can you hear us?
Hi, Fahad, are you with us? He's maybe got a problem. Nishi, do you have his question?
Yeah, I do have his question. Let me read it out for you. So he's talking about some notification from Aramco that Aramco shall not confirm to deduct VAT input in full, therefore applying 15% VAT, no matter a contract is signed before 11th May. You know, that's his concern, I think. So he's talking about that the company is supplying materials to Aramco through subcontract, and his contract is with the subcontractor, but end user is Aramco. So is there any impact on his company? Is it something that he should charge 15% to the subcontractor as well?
Well, you look on it contract by contract by contract. So Aramco at the end is saying, okay, we can't claim all the VAT. So it means the main contractor can't use the transitional rules. There, it's a question he needs to talk to the contractor that he's working to as to whether or not he can claim back the VAT. So, you know, you look at it contract by contract rather than the person at the end of the contract.
Yeah, I think it's worth mentioning that the question is around whether or not a price charged in relation to the service or the good delivered is inclusive or exclusive of any taxes such as VAT. So to the extent that it's exclusive, then I certainly wouldn't see why you wouldn't be entitled to gross up your invoice to include the 15% VAT, irrespective of whether the end consumer of whatever form it may be is able to claim back the VAT or not. Ultimately, the end consumer at some point, which is right at the end, cannot claim the VAT. But I think the magic is in terms of the contractual structure and the agreement in terms of what's inclusive and exclusive to the price.
Yeah, very, very important, those contractual terms and whether you're allowed to charge VAT. I mean, from the sound of things, Fahad has not got anything from the contractor he's working to, and therefore, assuming he can add the VAT, he should be adding it at 15%. What else we got, Nishi?
Yeah, up next we have Ala Khalaf. Ala, I have unmuted you. You can now ask your questions.
Yeah, how are you all? Thank you for
Very
this
well,
meeting.
thank you.
Yeah, actually, I have one question. As we know, the new rule in case of business-to-business communication, if the contract signed before 11 May 2020, so we have to still be charging the 5% VAT till end of the contract or the renewal or end of 30 June 2021. Okay.
Yep.
But that's in case if the client has the right to claim or to refund the input tax. But in case if he not getting this benefit, so in this case, after 1st of July 2020, should be started charging 15% or not?
Yeah, so if your customer can't claim the VAT or can't claim all the VAT on that contract, or if he doesn't give you in writing proof that he can, a certificate of some sort, then you charge 15% from 1st of July. Would you agree with that, Mohammed?
Yes, sure, Mr. Bryan, we agree. If you are not if the client has not the right to claim the VAT, he will not be able to. The provider of the service will not be shall not be apply the transitional rule.
So if the same case, but business to government, not business to business, is it the same thing? It's the same rules?
Government is different. Government is different in that government doesn't have to be able to claim back the VAT, and government normally can't claim back VAT. So if it's a contract with government, then you can just carry on 5% under the transitional rule. This is a special relief for governmental departments.
Yes. Okay, thanks.
Okay, you're welcome. You're welcome. Nishi, we got time for another one, I think.
Yes, we have a question from Mohammed Omar. I am putting you on live now. You can ask your question. Right, so I think there's some technical glitch from his end. His question is around the retailers and distributors, if they need to pay any additional VAT upfront on all inventories that they have.
No, they don't. They don't. It is only when they sell that inventory does the VAT become payable. So they don't have to make any adjustment to stocks that they're holding.
Right. Do we have some time for the last questions? Maybe we can take a few more.
I think we should. I think we can probably do another one, can't we?
So several attendees have asked that if other Gulf states will increase VAT or step up plans to introduce VAT as a result of what Saudi did.
Good question.
Good question. Yeah, Tom.
I have no idea. That's one for you guys. Yeah.
The answer is probably none of us have any ideas. One thing I can say, there has been absolutely no official announcement that any of the other countries will increase VAT. In fact, UAE has said it won't, and there will be no new taxes. So I've seen no indication that anybody is going to. There is a possibility that the countries that haven't yet got VAT, Kuwait, Oman, Qatar, might bring in VAT quicker than they otherwise would. But still, again, I don't think there's been any official announcement. So that's Tom and I saying we don't know anything. Mohammed, Andre, do you want to add anything to that?
No.
Crystal ball, that's what we need.
Okay, good. I think that's probably it now. We've gone over our time. I'd like to say thank you to everybody who attended, listened today. There will be a recording, I think, that will be available on our respective websites of the webinar today, so you can watch it all again and enjoy every moment once more. We've enjoyed it. I hope everybody else has. Thank you to our friends at Bracewell as well. So thank you very much, and hope to speak to you all again soon.
Thanks, Brian. Thanks, everyone.
Thanks, everyone.
Thank you. Bye-bye.
Bye-bye.